Time to spotlight the need-to-know info as we head into a busy earnings season. Joining us for that is Caleb Silver, editor-in-chief of Investopedia. Caleb, good to see you. Thanks so much for joining the show.
Thanks for having me. Good to see you.
All right, so Caleb, earnings season is officially underway. So far, Wall Street not very impressed, at least in terms of the bank reports. We'll get more bank reports next week. We'll also get Netflix, as Alex previewed, and Taiwan Semiconductor. What are your thoughts as we head into the earnings season?
It's kind of like companies need to show up right now just because they need to grow into their prices. Even though we've had a little sell-off here, we still have a very high forward PE ratio when you look at the S&P 500. So companies need to grow those earnings into those prices a little bit. But right now, sort of a muted start. There are pretty reasonable expectations, 3.2% for the S&P 500 when you look at earnings per share. If that happens, that would be the third consecutive year we have that. So the third consecutive quarter, I should say, of earnings growth, better than a lot of people thought. On the other hand, we have a lot of companies so far sort of downplaying and forecasting lower earnings, about 79 companies with negative earnings guidance, only about 33 with positive. We get around that, and companies usually surprise to the upside. You know how this game goes. But the weakness, looking at this quarter, we've already had a little bit of weakness in banking in terms of the guidance. Past quarter was great when you have those high interest rates. They're forecasting obviously lower interest rates towards the end of the year. So JP Morgan, one of them, not forecasting bigger net interest margins. But the weakness in infotech, industrials, healthcare, and consumer discretionary, that's where we're probably going to see the weakest earnings growth this quarter.
Yeah, you talked about that kind of muted guidance for net interest income for JP Morgan, but this is also a company or a stock that, as Kevin Hing said at the top of the show, was pretty much priced to perfection. Do you think that's going to be a common theme this earnings season, despite beats on both the top and bottom line? Maybe these stocks have run a little too far and Wall Street won't be forgiving?
Yeah, I think so. I think people are looking for reasons now to trim just because we've had such a strong start of the year and the prices have outrun the growth in a lot of cases. Now, JP Morgan's results were excellent if you just look at what just happened, but it's what's going to happen that investors care more about. So look carefully at the banks as they all have been reporting sort of that muted guidance in terms of net interest margins. That's where the profits are. These high interest rates cut two ways, right? They're good for net interest margins, but they're bad for lending. So banks are having to balance that out, but also a consumer that might be getting a little tired here as inflation has just become the overriding concern. So you're going to see those consumer discretionary stocks under pressure probably even more than they have been. When you look at the stocks making 52-week highs, none of them are in this sector. Only Alphabet when you look at tech stocks. But otherwise, you got gold stocks, some gold stocks at 52-week highs. You got aluminum stocks at 52-week highs. You got the miners and the silver miners like you were just talking about with your prior guests that are making 52-week highs. None of the consumer discretionaries, none of the infotech, none of the internet and communications except for Alphabet.
Well, speaking of tech, no doubt AI will continue to be a buzzword this earnings season. But how much could that actually drive share prices at this point? Is that priced in?
Yeah, it feels like it is, and it feels like that word is, or that expression, artificial intelligence, has been overused in a lot of earnings reports over the last couple of quarters, and for good reason. It's a revolutionary technology. It's obviously going to change the way we work, the way we operate, the way that companies are able to generate better profit margins. But how much can you get out of it until it's actually applied? I think investors want to see results from that. Investors only care about the future, and what they're concerned about here is, we may be facing higher interest rates until whenever. So that uncertainty is like kryptonite right now, and the options are still out there. There is alternatives in the 5% money markets right now for investors that just don't want to play right now.
Let's talk about investor sentiment. You have a proxy for that with the Investor Anxiety Index at Investopedia. Investors seem pretty anxious this week at least, but overall been a pretty good start to the year. How anxious are investors according to your index?
Yeah, well, it's peaking up a little bit for 2024 standards so far in the fourth month of the year. It's a little higher than normal than it had been prior, but I think most of that anxiety is not centered around the stock market right now. And even though there's a little uneasiness with the recent sell-off, it's more about personal finance. It's more about people's concerns about their own money, debt, and credit. We've seen spiking interest in terms related to taking loans, 401k hardships, best personal loans to take? Can you use a loan to pay your taxes? So this is this tale of two countries that we've been seeing a lot of. The shareholder class and the homeowner class has had a very, very good year plus, really since pre-pandemic levels, have done very well. But the other part of America that's not so heavily invested and doesn't own assets, not doing so great. So on Investopedia, we have all kinds of readers, a lot of people looking into ways to shore up their finances right now or deal with debt because that has been mounting month after month.
Really interesting insights. Caleb Silver of Investopedia, thanks so much for being here.
Thank you.